Every few months, someone posts a thumbnail with a red arrow and the words AI crash has begun. You know the type. Dramatic music, falling charts, a list of scary percentages next to famous faces, all designed to make you click before you think. But this time, the panic is not coming from nowhere. Something actually happened this month. Stick around because the real story is more interesting than the panic, and it is not the simple yes or no answer most videos are promising you. In theory, a bubble bursts when hype outruns reality. Prices climb on excitement, not profit, until reality eventually catches up and everything falls at once. That is the dot-com story everyone remembers, the one every AI crash video is quietly comparing itself to without saying so directly, and it is also the story behind the Great Crash of 1929, since economists point out these patterns tend to repeat across generations. In practice, this sounds simple, it isn't. In July, tech stocks genuinely wobbled as South Korean semiconductor sell-off spread fast across Asian markets, and one company, IBM, dropped 25% in a single day. Billions of dollars in market value vanished from global tech within a single week. Financial advisors started telling clients not to buy the dip until major earnings reports came out. That part is not exaggerated. It really happened, and it really did rattle a lot of portfolios. Here is where it gets interesting. The valuations backing this worry are real too, not just fear talking. Leading AI stocks are trading at price to sales ratios above 30, a level that has historically shown up right before sharp correction. AI companies now make up a bigger slice of the total stock market than the biggest dot-com stocks ever did at their peak in the year 2000. On paper, that looks like textbook bubble territory, the kind analysts write warning papers about. So, why hasn't everyone simply agreed this is 1999 all over again? Because the companies sitting at the center of this boom are not the empty shells from back then. Nvidia alone pulled in over $200 billion in revenue this year, up 65% from the year before. Microsoft, Alphabet, and Amazon are funding their AI spending using actual operating cash flow, not debt piles or desperate emergency stock offerings the way dot-com companies once did. That is a meaningful difference, not just a technicality investors are using to feel better. This is exactly why serious people disagree, and both sides have real evidence, not just gut feelings or vibe. Goldman Sachs and JPMorgan argue the growth is fundamentally justified by real revenue and real demand that keeps beating expectations quarter after quarter, and they point out that skepticism has been consistently wrong for 2 straight years now. Meanwhile, economists like Ruchir Sharma warn the whole thing could unravel fast if interest rates climb and cheap capital gets harder to find, since even genuinely profitable companies can get punished hard when money suddenly becomes more expensive to borrow. Both sides are staring at the exact same numbers and reaching completely opposite conclusions, which alone tells you this is not a simple case with one obvious correct answer waiting to be discovered. None of this means the crash thumbnails are lying exactly. Markets really did wobble this month. Real money really was lost. But calling it a full collapse skips over the part where actual profits are propping up these sky-high valuations in a way that simply did not exist the last time everyone panicked like this back in 2000. So is the AI bubble bursting? The honest answer is nobody fully knows yet. Not even the economists getting paid handsomely to know. Either direction is probably selling you something. What we do know is that the difference between real cash flow and pure speculative hype is going to decide who ends up being right, and that distinction is exactly what most panic videos conveniently skip past on their way to showing you another scary red arrow chart with someone's face stamped next to a falling percentage. If breaking down the actual data hiding behind the panic headlines is useful to you, you already know what to do. Subscribe, because the next confusing headline dressed up as a crisis is already on its way, and someone needs to actually explain it properly.